In this portion, we're going to be focusing on current liabilities. The definition of a current liability is it's expected to require the use of current assets or the creation of other current liabilities to settle the obligation. This is a little more nuanced than our looser definition in the past, which basically said it's a current liability because we're going to pay for it in the current period. Notice we're looking for the source of funds that are used to pay the liability. If they come from current assets or the creation of other current liabilities, then we classify it as a current liability. Otherwise, it will be long-term. They're recorded at their face value. In other words, whatever it says it is, it is. And the major problem that you have with current liabilities is you sometimes forget they exist. And so you need to remember to account for all your current liabilities, all those promises that you've made that you will fulfill in the coming period. Examples of current liabilities, well, definitely determinable, meaning how much, when, and who to. If we know those things, we make journal entries for these types of current liabilities. And they should look pretty familiar because we've seen them in the past. The other type of current liability is those estimated ones, and these estimated liabilities come about because of accrual accounting, where we accrue or expense it now and we'll pay it later. And here are some great examples of those. Now let's see if we can identify the following as whether they're current or long-term. In number 1, the accounts payable are owed to suppliers for inventory. So it's a current liability because accounts payable are our current bills that we pay currently. A good example of that is your credit card bills. Number 2, we have a $60,000 note. It's due in 3 months, so it looks current. But notice that the company plans to acquire a 5-year loan to pay off the note, and the bank has agreed to grant that loan. So if we're using long-term liabilities to pay off a current liability, it's classified as long-term because the source of funds is long-term. $500,000 mortgage in number 3. We've got $75,000 is payable within the next 12 months, and the remainder is payable in the next 6 years. So $75,000 of this is a current liability, but the remainder, $425,000, is a long-term liability because we'll pay it out over the next 6 years, whereas the current will be paid within the coming year. Number 4, $8,000 owed to the phone company for December services. That's a current liability. Phone company does like you to pay those bills on a monthly basis. Number 5, advances of $25,000 are received from a customer. Another way to say advance is unearned revenue. That's where the customer pays you the cash in advance of you rendering the services to them. If the services are not performed within 6 months, the $25,000 will be returned to the customer. So since these are current promises that will be fulfilled in the next 6 months, it's a current liability. Number 6, $15,000 is due the federal government for income taxes withheld from employees during the last quarter, and they must be submitted by the end of the next quarter. So within a short period of time, the federal government wants you to remit those taxes, thus it's a current liability. Number 7, we have a $125,000 note. $30,000 is payable within 12 months, and the remainder over 2 years. So you're saying to yourself, $30,000 current liability, the rest is long-term. But notice the current payment will be made by issuing common stock. Thus, the $30,000 that's payable within the 12 months is going to be paid from non-liability sources, non-current sources, not either current assets or current liabilities. Thus, it will be long-term. And finally, company declared a cash dividend of $50,000 on December 29th. The dividend will be paid next year on January 21st. Now notice that January 21st is within the month. Many students will say, oh, that's long term because it's due next year. But the next year is less than 30 days from now. So thus, it's a current liability. So hope you enjoyed learning about current liabilities versus long-term liabilities.